We also had some economic data coming in. Consumer sentiment sank further in July. We want to talk about that and the economy with our next guest. It's Nouriel Roubini, the professor of economics from NYU's Stern, also the CEO and co-founder of Roubini Macro Associates. Nouriel, it's always great to be with you.
Great being with you, Julia.
Well, I think one of the things that folks are really interested in today, I mentioned it was July 31st. Of course, the $600 extra unemployment benefit is expiring, and we haven't seen a deal reached yet as to what the extension, if there will be extension, what that could look like. So my question for you, Nouriel, is what are the effects of that? We're talking about a lot of people who could be affected.
Absolutely so. You know, there are still about 30 million of continuing claims for unemployment benefits. So about 30 million people are out of jobs and need this income as a way of paying their rent or their bills and so on. And the fact that there is now this gridlock in Congress and in Washington doesn't bode well at the time where economic activity looks like it's stalling, because the surge of cases in the Sun Belt, in the South and the West, because we reopened too soon, too fast, is already leading to an increase in uncertainty, to effectively partial lockdowns, people becoming more cautious, both businesses, consumers, and households. And if on top of it, you're going to have a fiscal cliff and there's not going to be a clear resolution to this gridlock, then that's going to bear even more negatively on consumer sentiment, business sentiment, and even investment sentiment.
Nouriel, do we need another round here? Like, what do you think needs to happen to kind of stem some of this here? What do you think would be the appropriate next steps?
Well, we still need a significant fiscal stimulus because the unemployment rate is still huge. About 30 million people rely on initial claims for paying their own bills. And if there was not a stimulus of at least $1.5 trillion for the next few months, the economy is going to slow down further. People had hoped that this will be a V-shaped recovery, but what's happening is that the business sentiment and consumer sentiment is already stalling because of the increase in coronavirus cases. So that's already softening economic activity. The income of people is still constrained by the fact that economic activity is slow, unemployment rate is very high. The Fed is doing its own share, but more than monetary policy, what matters right now for people is having income in their paychecks, and therefore whether it's unemployment benefits, whether it's more PPP loans, whether it's aid state and local government, whether it's more food stamps and other types of support for healthcare and so on. We need still a significant boost from the public sector because the private sector is deleveraging. Households and corporates are spending less, are saving more, doing less capital spending, less investment in residential. So unless the government does its own part to save and boost the income of the private sector, there will be a sharp slowdown. The V could become a U, the U could become a double dip recession, and over the medium term, there's even a force that could lead to a greater depression. So we are playing with fire, but not reaching an agreement.
Yeah, it certainly makes you wonder what it could mean for the psychology, at least when they have a delay, as to, you know, what the future could look like. I guess one of the things that's been talked about, and I would like to get your take on it. We were talking earlier just about, you know, consumer sentiment, for example, and yet you still see this divergence between the consumer sentiment and when you look at the markets. I know it's a down day today, but for the most part, I mean, the markets have done quite well through the pandemic. So how do you explain that divergence and what that means?
Well, in my view, there is a divergence between the interests of Wall Street and those of Main Street. Wall Street is representing big firms, big tech, big banks, while Main Street is households, workers, and small businesses. What's going to happen is that millions of small businesses are going to be decimated. They're going to run out of options. They're going to shut down. The market share of big firms is going to go higher, but small businesses are those that are creating jobs and creating income and creating economic activity. Secondly, firms are going to be slashing costs to try to survive and thrive and achieve the Wall Street earnings target. But, you know, my labor cost is somebody else's labor income. And even if and when they're going to start to hire again, they'll do like they did after the global financial crisis, hire people not with full-time jobs, with full benefits, good wages, and formal contracts, but informal contracts, part-time jobs, hourly, contractors, freelancers, gig workers. So there'll be a huge amount of insecurity for workers and for labor. So Wall Street can go higher, but Wall Street doesn't represent Main Street and the real economy. And there's the gap between what are the interests of Main Street and those of Wall Street. So that's the way I explain the divergence between the real economy and what asset prices have been doing.
Mm-hmm. You're just unpacking, what the jobs looked like post 2008 financial crisis, and more gig workers, for example, and not as many full time. I would also be curious to get your take on this. Do you think that there could be potential for a white collar wave of job losses to come, especially as companies start to realize, or maybe they do start to realize this, the productivity, or maybe they don't need as many people working, they can find like who's working and who's not working. Is that something that's been on your radar?
Absolutely so. One of the winners is going to be big tech and things like AI, robotic, and automation. The first round was, of course, in manufacturing, and eventually the factories of the future are going to have very few workers and mostly robots and machines. But now we know that AI, robotic, and automation can actually displace tons of jobs in services. For every job created by Amazon, there are probably 10 jobs that are destroyed in retail. You go to the supermarket today and you have express checkouts without the tellers. Whether you're looking at government, education, transportation, eventually we're going to have self-driving vehicles, and millions of truck drivers or Lyft or Uber drivers are going to be within jobs. So initially, automation robotics was challenging blue-collar workers, but there's going to be a wave of jobs that are in services, including financial services. Eventually, the great fintech revolution implies that you can do payment system, credit allocation, insurance, asset management, even capital market activities with less workers, and machines and robotics and AI doing most of those jobs as well. So that's the other threat the economy is facing, of technology that is increasingly capital intensive, skill bias, and labor saving, not just blue collar jobs, but increasingly also white collar jobs, and not only low value added, but even medium value added jobs.
Mm-hmm. Well, no, Nouriel, I read your book, and you did predict the 2008 crisis with such precision, and I've been following a lot of your writing lately, and you did recently write about, the Greater Recession of 2020 has not yet become a Greater Depression, but you do talk about how the global economy remains fragile, and you look at things, it's beyond just the COVID-19 pandemic, but you've been looking at a lot of different factors. You call them white swans, things that you had been talking about going back to February before it became a global pandemic. What are some of the things that are on your radar right now, and what are some of the things that aren't getting talked about enough?
Well, there are these other factors that are going to be negative for economies and markets. We have a greater strategic rivalry between the United States and four powers that are trying to challenge the US power: China, Russia, Iran, and North Korea. They cannot challenge the US conventionally. They're using asymmetric warfare with cyber by trying to interfere with the US election. These elections are going to be very chaotic. Either side loses is going to argue that it's been rigged, and that even social and civil disorder. That's one. The Cold War between US and China is becoming colder on trade, on technology, data, information, investment, portfolio, monetary, currency affairs. And some people are even starting to worry that eventually there may be even a military confrontation between US and China, as we have a rising tension in Hong Kong, in Taiwan, in the East and the South China Sea. You have, of course, medium-term environmental concerns, and there is now a strong link between global climate change and these pandemics, as we're encroaching on animal ecosystems, and you have transfer of diseases and viruses from wildlife to humans. I think that in the future, the damage is going to come from the combination of pandemics becoming more frequent and global climate change going to imply significant economic and financial risk. We had HIV, then SARS, MERS, swine flu, bird flu, Zika, Ebola, now COVID. We're going to see more of these things, and we've seen that we are not able to control these pandemics. And a pandemic like this one has caused more economic damage. Output collapsed by more than 30% in the second quarter than any even previous financial crisis. So we live in a world in which there is also going to be deglobalization as firms countries are trying to protect their own workers and their own firms. Deglobalization means decoupling between US and China, reshoring of economic activity, fragmentation of the global economy, having things like balkanization of global supply chains. All these are negative shocks. And politically, we're having a backlash against liberal democracy as autocrats and populist leaders are becoming more popular, both in advanced economies and emerging markets. So beyond COVID, there is a wide range of other challenges that are political, geopolitical, social, technological, environmental, and health ones that can damage economic activity over the medium term.
Yeah, certainly a lot of tail risk out there. I would like to get your take, Nouriel, on gold. We've seen gold surge to new heights. What's your outlook for gold, and do you think it is a useful hedge for some of these?
Yes, gold prices are going higher because, first of all, we have massive monetary easing, and both nominal and real yields are going lower and lower. Secondly, there is this debasement of fiat currencies occurring as we're monetizing large fiscal deficits. In the short run, that's to try to avoid the deflation, recession, and depression. But over time, this build-up of the balance sheet of the central banks may lead eventually to an increase in inflation, especially in a world in which there'll be negative supply shocks like deglobalization and less tech innovation. And therefore, gold is an hedge against both economic, financial risk, the potential eventually medium-term rise in inflation, the debasement of fiat currencies. The dollar is weakening because of the US policies, and that strengthens gold prices. And there are also geopolitical risk. The Chinese, the Russians are starting to worry that their reserves of treasury holdings may be eventually seized or defaulted upon by the US, and therefore they're selling treasuries and are going into gold. And that's another driver. So I would say probably it's a good time to be slightly overweight in gold as a general hedge against a variety of tail risks.
All right, well, before we head into break, just really quick, if you could narrow it down, what is the one thing that could help catalyze growth? I feel like that's something that we haven't been discussing so much when it comes to stimulus and some of the measures. What is that one thing, if you could narrow it down, that would catalyze growth for our country?
I would say we need badly infrastructure spending, both on our basic infrastructure like roads, ports, and other basic infrastructure, also in the digital infrastructure. And we have to invest also in the green economy of the future. And therefore, also investments into the green economy are necessary. Those types of infrastructure investments are also labor intensive, and we have a serious unemployment problem. So I hope that whatever is the result of this election, we're going to have a real significant plan to invest into our people, into workers, into the infrastructure we need. So that's one thing that is really missing as part of the fiscal stimulus.
Nouriel Roubini, I always appreciate you taking the time to join us on Yahoo Finance. Thanks for your thoughts today.
Great being with you today.